All right, we are live again tonight, starting a little bit earlier. I feel pretty good right now, so hopefully be able to have a nice show tonight. So, the more I learn about what happened in the last 4 or 5 weeks, the more I am convinced that absolutely everything collapsed. Whether it's Wells Fargo, which has an enormous commercial real estate loan book, the largest by far, or how much collateralized loan obligations Wells Fargo has now, when Warren Buffett said that financial derivatives are weapons of mass destruction. Hypocrite. But also the stories that are coming out about hedge funds. So we've had people like Eric Townsend of Macro Voices. I've interviewed him in the last year or two. He's been warning people about the risk parity trading strategy, which was founded by Ray Dalio over at Bridgewater. A lot of other large hedge fund managers and bond portfolio managers at investment banks were copying the risk parity trading strategy, which to try to boost returns and smooth out the returns, because normally bonds are not really that exciting. So these are unhedged, over-leveraged bond trades by hedge funds using risk parity. So over-leveraged 10x or more, going into the repo market and borrowing, and then leveraging up 10x borrowing repo funds, leveraging up another 10x or more on investment-grade corporate bonds or high yield, which is junk bonds. And then this other trade that hedge funds were doing that honestly I didn't even know about until recently, because all the experts I was paying attention to, like Christopher Cole, who is a volatility hedge fund manager, most of his warnings have been solely about the risk parity trading strategy blowing up. Eventually, he's been warning about that for the last couple of years. Also, and the leverage short volatility trade. Also, Eric Townsend, like I said, been warning about from Macro Voices, a professional money manager and co-host of the Macro Voices podcast. He's been warning for a while about risk parity blowing up too. So we have this other big trading strategy that hedge funds were using, and I think it was related. Now that we're 7 months removed from Repo Madness, which started late night, September 16th, 2019, I think now that we're 7 months removed from that, I think it's pretty clear that this other hedge fund trading strategy, besides risk parity, also had problems and started to cripple, basically kill, a lot of large hedge funds back then. So 7 months ago, and these hedge funds limped along while the people in power, whether it was the Federal Reserve in congressional testimony, Jerome Powell in congressional testimony, the vice president, I think Quarles in congressional testimony, lied about how the repo problems were fixed. It wasn't that big a deal. People in Congress and the American people shouldn't pay attention. I think that was the warning signal that this trade I'm going to talk about also blew up. And the reason is because that was related to the treasury market back then. So there was a lot of problems in the repo market. There was at least 4 or 5 really, really big things with Repo Madness. You had primary dealers who could not afford, they were legally contractually obligated to buy all the treasuries, 24 primary dealer banks and Wall Street stock brokerage houses to buy all the treasuries that the U.S. Treasury had to sell. So if there was no demand, the primary dealers had to buy the treasuries at auction anyways. So they went into repo. You had hedge funds that were borrowing in repo, and you had them then leveraging up the repo borrowings 10x or more on some of their trades for risk parity trade with corporate bonds or high yield debt, junk bonds, or also the basis trade. You had a very, very big move prior to the Repo Madness becoming public. You had a very big move, 26% move in yields for the U.S. Treasury, the 10-year. So it was a big move in a very short amount of time. It moved over 26% on the yield. There was a big swing. I've covered this. And in hindsight, I knew that there was problems with leveraging up and playing treasuries because I'd been reading articles talking with hedge fund managers where they were disclosing that they were buying treasuries and using leverage. So it wasn't specifically labeled the basis trade, but now we're getting articles coming out in the last couple weeks, whether that's the one you see on your screen on March 21st from Zero Hedge confirmed Fed bailed out hedge funds facing basis trade disaster, or the one on March 17th from Bloomberg by Steven Spratt, how a little known trade upended the U.S. Treasury market. So let me just talk about repo a little bit more, and then we'll get to the basis trade. So I think the background's important because I think in hindsight now that the basis trade started to blow up then in September and these hedge funds were limping along. Some of them were probably basically dead and using repo to survive, to claim that they were still solvent and not insolvent. And then the death blow came in the last month or so. So besides the primary dealers and the hedge funds in the repo market back then, we also had the Federal Reserve, which was giving large foreign, basically all foreign central banks who wanted to, the foreign central bank reverse repo pool. This was covered by Bloomberg articles, I think in November or December. And so there was $300 billion approximately in foreign capital parked at the Fed, and it was earning interest rates way higher than American pension funds and American savers and American retirees were allowed to get. So the Fed was just paying them enormous sums of interest to dock the funds there. And then once reporters started running stories about the foreign central bank repo pool, and then the Macro Voices interview came out with Danielle DiMartino Booth and George Goncalves, who George Gammon has interviewed in the last month or so. Excellent interview, must listen. He's also been interviewed, I think, on Macro Voices and elsewhere too. Also, Real Vision TV. You can follow him on Twitter. I think he's at Bond Strategist. So once that became public, that the Fed was giving foreign central banks all this extra interest income, then the Fed kicked all that foreign capital out. So that was one of the main problems. So you had a number of different problems connected to the repo market. There was at least 4 or 5 big ones there. So it was the other one was money market funds that were loaning into repo. So you had these hedge funds going bad with some of their bad bets on either U.S. Treasuries or corporate bonds back then that were over-leveraged and their trades were going bad. And I was getting screenshots from some of my podcast listeners because I was warning them. I was reading articles about Bank of New York Mellon bragging about their private repo, their tri-party growth for their repo market, their private repo as a custodian. And in only about 3 years, Bank of New York Mellon had taken their repo business from basically zero to $100 billion per month in loans for their private repo market. And they were bragging about how they were taking money market funds and they were loaning them out to hedge funds. And then the hedge funds, I don't know if Bank of New York Mellon knew exactly how much leverage the hedge funds were using, but the hedge funds were taking way too much risk with the repo money. And so you had these, with central banks manipulating interest rates lower with financial repression, you had all of these money market funds and pension funds just desperate for income. So they were willing to get a little bit more income. These money market funds were loaning a lot of their investor capital, which is not supposed to take that type of risk, into repo. And then the hedge funds were then taking those funds and leveraging them up even more on risky trades on treasuries and investment-grade corporate bonds and junk bonds. And then those trades started to blow up back in September when Repo Madness became public. So the money market funds, and this is why the Fed has done these bailouts with money market funds and commercial paper, money market funds and hedge funds. The money market funds and the hedge fund bailouts that the Fed has done in the last month are all connected to repo. It started in September. So there was really big problems in the repo market with hedge fund leverage, the money that was borrowed. I don't know if the banks that were allowing the borrowing knew that the hedge funds were taking that type of risk with the repo money. The foreign central bank reverse repo pool, the primary dealers could not offload the treasuries. That's why the Fed had to step in pretty shortly after that. And now you have these stories coming out in the last couple weeks about the basis trade. So back in December, when the world was still confused about what exactly happened before and after the September repocalypse, or as I dubbed it, Repo Madness, which has since exploded thousandfold, resulting in the Fed now doing daily 1 trillion repo operations. So 1 trillion is available, but 1 trillion is not being borrowed right now, because the Fed has created so many different bailout programs that I think the banks and some of the other counterparties, maybe hedge funds, think that they don't need access to the repo anymore. So we said that in addition to the implicit bailout of JP Morgan, which was described in other articles, by restarting its repo operations, the Fed was also bailing out dozens of hedge funds engaging in highly leveraged trades involving a relative value compression trade in the Treasury cash swap basis, almost identical to what long-term capital management was doing ahead, or LTCM, was doing ahead of its 1998 bailout, which is also why we titled the article, "The Fed was suddenly facing multiple LTCMs." So that was a couple months ago. In a nutshell, that article came out a couple months ago. In a nutshell, the article explained why and how the return to the Fed's repo ops was nothing more than the Fed preemptively bailing out all those hedge funds that would have imploded had basis trades gone haywire. Below is a key excerpt from that post. Quote, one increasingly popular hedge fund strategy involves buying U.S. Treasuries while selling equivalent derivatives contracts such as interest rate futures and pocketing the arbitration difference or difference in price between the two. While on its own, this trade is not very profitable given the close relationship in price between the two sides of the trade, but as long-term capital management knows too well, that's what leverage is for. Lots and lots and lots of leverage. So normally you can't generate these types of returns in a short amount of time doing that type of trade, and that's why the hedge funds are desperate for returns, greedy hedge funds, hoping for a bailout probably. Unhedged hedge funds, as I said there in the title, are leveraging this trade up 10x or more. And if you don't know, if you're new to finance, what a 10x or more trade means is that all it takes for you to owe more money, for you to get wiped out on that trade, is for you to have your assets that you're leveraging up 10x or more drop 10%. So if you're leveraged 40x, like what I think Lehman Brothers was 40x, Bear Stearns I think was 60x. So Bear Stearns was leveraged 60 to 1 on their entire assets and derivatives book. So all it took for Bear Stearns to be insolvent was less than a 2% drop because they were leveraged 60 to 1. So it was, what, 1.5% approximately. I think 1.5%. And Lehman Brothers was, what, 2.5 because Lehman Brothers was 40 to 1 on leverage. So that's why those banks failed, because they used way too much leverage on their bets. So all it took was a tiny little drop in the asset prices and they were wiped out. And that's how they got in trouble. Now, there were other parts of the businesses that were profitable, but they had such huge losses in certain parts of their business with the mortgage-backed securities and, you know, the real estate loans, you know, that were chopped up and packaged. So these hedge funds that, according to sources that I've spoken to about the risk parity trade, were leveraged 10 to 1 at least, which means that a 10% drop in some of these corporate investment-grade corporate bonds, and these investment-grade corporate bonds are seeing downgrade credit ratings downgrades. So all it would have taken was a 10% drop. And we know that a lot of the investment-grade corporate bond market, the leveraged loan market, the high-yield debt market, a lot of these things, even LQD, which I think was a, corporate bond ETF, those things all went for at least like a couple weeks. They went no bid in the last 4 or 5 weeks. So there was more than a 10% drop. So these hedge funds that were leveraged 10 to 1, they were basically, at least on part of their books, could be more or all of them insolvent. And that's why they got bailed out. Okay, we also, back to the article, we also said that, quote, hedge funds such as Millennium, Citadel, and Point72, by the way, President Trump just had a phone call, I think last week, it was disclosed, with like a lot of these guys, the CEOs of a lot of these hedge funds, and Stevie Cohen, too. Point72 are not only active in the repo market, I think Point72 is Stevie Cohen's hedge fund, are not only active in the repo market, they are also the most heavily leveraged multi-strat funds in the world, taking something like 20 to 30 billion in net assets under management and leveraging it up to 200 billion. So if you only have 20 billion in assets under management and you leverage it up to 200 billion, that's 10 to 1 leverage. If you have 30 billion in assets under management and you leverage it up to 200 billion, that's a little under 7 to 1 leverage. They achieve said leverage using repo. Bingo, repo. So the repo market, in hindsight, we now know 7 months later that the repo market was the warning signal that things were falling apart. Just like how in the Grant Williams interview that I did last week, he was talking about TED spreads. Actually, it was a couple days ago. Grant Williams' interview was a couple days ago, talking about TED spreads. How that was a precursor to the 2008 financial crisis. So the repo 7 months before was a warning signal that things were breaking, that they were lying to us, that things were much, much worse. Needless to say, and remember, I've been warning about that. I thought repo was very serious. Okay, well, all the mainstream financial people, mainstream financial media was brushing it off. The Federal Reserve was brushing it off. The guys on CNBC and Bloomberg, most of them on CNBC and Bloomberg, wearing $5,000 more suits, stuffy shirts, were brushing it off. That the economy has outstanding fundamentals, and the bull market will continue. Dow 35,000 on fundamentals. No, not on central bank balance sheet expansion. Dow 35,000 on fundamentals. No central bank balance sheet expansion for why the stock market's going up. Those people are saying, oh, you're overreacting on repo. You don't know what you're talking about. Uh-huh. Meanwhile, they're still running TV commercials for now is a good time to buy stocks. They didn't warn you about the crash. There's at least a couple billionaires running TV commercials now that I've seen in the last 2 days. They didn't warn you about the crash coming. Anyways, I'll get off my soapbox and a rant for that. Needless to say, as always, when this website presents something the mainstream press hasn't even considered, our explanation of what really happened ahead and during the September repo madness was met with traditional mockery and derision by the financial intelligentsia. Until today, 3 months later, when Bloomberg finally confirmed everything we said. In an article discussing how and why the Fed unleashed its March 12th repo bazooka, Bloomberg writes that, quote, when the global pandemic kicked off, unprecedented turmoil in treasuries last week, hedge fund leverage was lurking, and goes on to explain something we said back in December. Quote, the hedge funds used borrowed money from the repurchase market or repo market for the popular basis trade, which exploits, and I was talking about this, you could see it in the chart back in September. You could see in the chart with how quickly the 10-year U.S. Treasury that there was some hedge fund. I said it back then. If you're new to my channel, you can go back in the archives and listen. I showed it on the charts. I talked about it in audio in a short video. I said it was hedge funds. They were over leveraged. They were caught on the wrong side of the trade. I didn't know it was the basis trade back then because no other experts were talking about the basis trade. All the people I follow were talking about the risk parity trade and how it was going to blow up. So we had two big themed hedge fund trades blow up in the last month or so. Popular basis trade, which exploits price differences between cash treasuries and futures. And by the way, none of this would happen, as my friend Doug Nolan would say, none of this would happen without unbelievable amounts of cheap credit. So with all this credit, with all this paper out there, cheap leverage that these hedge funds don't have to post a lot of collateral for, they're going to take the risk like this, and they're unhedged. These hedge funds are not really, most of the hedge fund managers I've spoken to are way overconfident and they don't hedge. Though individual firms' borrowing is a closely guarded metric, people familiar with the transaction said some of them leveraged up as much as, oh my God, I didn't know it was this bad. With the transaction, some of them leveraged up as much as 50 times their own wagers. 50 to 1. That means a 2% drop in asset prices, and that trade is wiped out, and they end up owing more than they risked. So if that trade goes, if there's more than a 2% asset drop, those are enormous margin calls. Those are many, many billions of margin calls, depending upon how much the leverage was. Tens of billions per hedge fund, maybe even over 100 billion per hedge fund that was doing this, or per investment bank with their bond manager, with their bond portfolios. And this was going on, I believe, in the investment banks too, at their bond portfolio desks, because I've heard that. I also heard rumors that Dalia's Bridgewater, with their risk parity, they had redemptions, enormous amounts of them from the Saudi royal family, and that they got blindsided. They got crippled too in the last month. I haven't seen, it must be because Dalio has really positive media coverage. I haven't seen anyone talk about Dalio. I've seen other hedge funds mentioned. I haven't seen Bridgewater mentioned. But that's what I heard from my source who told me about how bad things froze up in the bond markets, the credit markets in the last month or so. Specifically, Bridgewater was mentioned from the source that's connected to investment banks and really high asset under management bond portfolio managers. Okay, 50 to 1. That is insane. Leverage, that's between, that for perspective, that's between Bear Stearns and Lehman Brothers leverage. Leverage funds exposure to the basis strategy could be as much as $650 billion, JP Morgan Chase and Company strategist said. My God, that's insane. No wonder the Fed is doing uncapped QE. No wonder these hedge funds and bond portfolio managers and their bosses and risk officers told them to be net sellers, to sell 90% of these bonds as much as quickly as possible. And everyone was trying to head to the exits. And no wonder, since once these things went no bid, the Fed had to step in, because the Fed eventually has to step in when things blow up like this, when a leveraged trade blows up like this. And there is no buyers. The Fed has to step in, create trillions of dollars out of thin air with all these bullshit bailout programs, alphabet soup. They're violating their own laws. They're creating, according to Danielle DiMartino Booth, she put out a tweet yesterday, it is illegal for the Fed to buy investment-grade corporate bonds. So the Fed because the Fed would normally have to go to Congress to get the laws changed. So that what did the Fed do? They just created a special purpose vehicle or a dummy company or dummy corporation. And that dummy corporation, wink, wink, nod, nod, which is, separated from the Fed, wink, wink, nod, nod, is going to buy trillions of dollars in investment-grade corporate bonds and probably in the near future, a lot of junk bonds too. At least half of the investment-grade corporate bond market, trillions of dollars, 3 trillion or so, according to bond fund manager Bruce Richards, he did an extensive interview in the last couple weeks on Bloomberg, is going to be bought by the Fed, maybe even more than that before we're done. The Fed may end up owning all of these investment-grade corporate bonds because these things are going to end up probably being credit ratings downgrade down to junk. And the banks were holding these things. Their bond portfolios were enormous, these investment banks and banks like Wells Fargo. And the value of these corporate bonds, investment-grade corporate bonds, high-yield debt, leveraged loans, collateralized loan obligations, subprime auto loans, all the value of these bonds are falling like a rock. Welcome to dystopia. Okay, does that sound like, quote, the Fed suddenly facing multiple long-term capital managements? Because to us it sure does, and more importantly, what happened in the days ahead of last week's credit market debacle is precisely, so that was a couple weeks ago, what happened, because this article is from March 21st, what happened ahead of the September repo snafu, only with exponentially more destructive power. So these are hedge funds getting more and more desperate for returns that leveraged up even more, and they didn't hedge. Unbelievable. The catalyst for last week's repocalypse was a historic surge in treasuries that saw the 10-year drop as low as 0.31% and the 30-year drop below 1%. As investors scrambled into treasuries, quote, hedge funds got hammered again, and the result was a difficulty in completing trades, which, as Bloomberg correctly writes, quote, was a contributing factor to the Federal Reserve's decision to pledge $5 trillion to keep markets running smoothly. High leverage amplifies profits and losses and can be responsible for forced liquidations. We had a number of days of forced liquidations or enormous margin calls where gold and Bitcoin and gold stocks and other quality assets were puked out. Okay, forced liquidations and market fluctuations. Former hedge fund manager Jesse Felder, I spoke to him on Twitter about this as it was happening, and he said that it was hedge funds forced liquidations. This was a couple weeks ago. This week, a sell-off in Treasury futures tied to margin calls published outstanding contracts to their lowest level since 2018. Many firms also get funding from money markets, and this is the problem. Money markets loaning into repo, not knowing where the money's bet on with what leverage, whose problems have prompted the Fed to provide emergency funding. The Fed now has a repo facility bailout too, because it was connected to repo because the hedge funds used the repo money from the money markets. Some of these money markets had 30%, 40%, 50% of all their investor capital tied up in repo. Dumb, 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 dumb. But I guess in an environment where people are desperate for income, desperate for yield, stuff like this is going to happen. The majority of blame goes to the central banks for financial repression and these over-indebted governments that refuse to cut spending. And there it is, just as we said, the Fed's first priority in the bailout waterfall, long before consumers and businesses were even considered, was the sanctity and stability of those multi-billion-dollar hedge funds that suddenly faced a spectacular implosion, just like in the case of the original long-term capital management. Only it's even more poetic because whereas with long-term capital management, which blew up when an economic black swan, the Russian default, and the Asian crisis of 1997, blew out the long-term capital management basis trades, forcing the first Fed bailout in the modern era with currency swaps. Those were a lot smaller back then. What happened last week may have been the very last bailout cascade in Fed history, only this time it will involve everything. The Fed's doing more bailouts. The Fed's going to back this SBA loans too, and the large banks are still not lending, assholes. Not just one solitary, because I dropped a cuss word there, this video will probably be demonetized. Smash the like button anyway. Not just one solitary hedge fund run by idiot Nobel Prize winners. Quote, too big to fail is back, and this time it's not the banks. Actually, it is the banks too, based on what I heard from my contact who is a podcast listener, upper management at one of the largest credit ratings agencies. The banks also got hammered too, with the value of their bond portfolios collapsing. They couldn't sell, so the Fed has to come in and overpay at 100 cents on the dollar for a lot of this toxic garbage. The European banks got stuck with leveraged loans and collateralized loan obligations. And then you have Wells Fargo there. Like I said at the beginning, Wells Fargo has an enormous commercial real estate loan book, the largest by far, and a large leveraged loan and collateralized loan obligation exposure. its leveraged financial institutions, said Mark Yusko, the chief executive officer of Morgan Creek Capital. Yusko, who apparently forgets the original Fed bailout was not of a bank, but of a leveraged financial institution, said he supported the Fed stepping in, but added that hedge fund firms have gotten too big by borrowing too much. Quote, "It's a bailout," Yusko said, repeating what we said in December. And whereas Bloomberg failed to connect the dots last year, this time around, it actually did some original reporting and found some of the smaller hedge funds that would have been devastated had the Fed not stepped in with its $1 trillion a day repos. So it lists some of the other repos. The rest of the article will be in the information and description section. I think I'm too pissed off to read the rest. It's just unbelievable how the economic and political elites get all these mulligans. It's just so freaking screwed up. Okay, let me look. There's also, like I said, a really good Bloomberg article from March 17th by Steven Spratt. It'll be in the information and description section, how a little-known trade upended the U.S. Treasury market. This is also about the basis trade. And then I have other articles here about risk parity trade and basis trade. They'll be in the information and description section if you want to read it more about those. But these are if you want to simplify things, if you don't want to know all the details, these are over-leveraged bond trades. These are unhedged hedge funds that did drastically over-leveraged bond trades. And then the value of the bonds collapsed. And because of the leverage, the hedge funds needed bailouts. That's as simple as I can say it in under a minute. Finance Freak asks, how bad will mortgage payments and WeWork collections be this month, and will banks report it? There is an excellent article from Christopher Whalen. It's not on his blog website. He sent it out to his email list. He was asked by one of the mortgage news websites. It's in the Wall Street for Main Street Facebook group. I forget the exact URL for it. It's really, really good. He goes through it. So it's $11 trillion mortgage finance industry, and there's about $35 billion per month in payments that are being missed. And he said the CARES Act, which is Congress's coronavirus bailout, has not covered bailing out mortgage servicers and the other mortgage finance industry. So they're trying to scramble now to figure it out. Meanwhile, the industry is the mortgage servicers cannot afford $35 billion a month in losses, and the banks are struggling with that too. So you hear the narrative in the mainstream media, the mainstream financial media, Wall Street professionals, that all the banks are fine. It's not true. Canada even created QE. They're doing what the U.S. did in the 1980s. They're moving all the bad stuff with the QE. They're moving it into a nationalized bad bank. But yes, all the banks are fine. Meanwhile, we have all the rules changes, all the money printing, all the quantitative easing. Japan just announced an enormous new stimulus bailout package. I think it's over $1 trillion. The European Central Bank did one in the last 10 days, over 750 billion euros. But yes, the banks are fine. The Fed had to do global repo. The Fed had to do how many swap lines, the currency swap lines. And then on top of that, yesterday the news came out that 84 different countries, because the global economy is broken, the supply chain is broken, and other foreign companies are not earning their dollars in the dollar standard system that we have now through trade with American tourists or American companies buying goods and services outside the U.S. So they're not earning their dollars, that they had to ask the IMF for even emergency relief too, for more dollars. But yes, the banks are fine. You can believe CNBC or Bloomberg all you want. I do not. Raymond Morales says he's just became a Patreon patron. He says, I'm the man. Thank you very much, Raymond. I appreciate it. I have almost 700 patrons now. For as little as $5 a month, you can get a lot of research behind the paywall. A lot of well-written articles, technical analysis charts, and audio podcasts. There's a lot of stuff beyond the paywall. There's an alarming level of people asking about junior mining stocks, though, that have no cash on, little or no cash on the balance sheet and no cash flow. I'm getting tons and tons of questions about those. I really hope people own companies that can actually make money first. But I suspect that that's not the case. Because a lot of people want to gamble and they want to try to get rich with the junior mining stocks. Those things a lot of them are frauds. Not all of them, but a lot of them. There's stuff I cannot say publicly because if I said it publicly, I would get sued. It is big time buyer beware, caveat emptor for a lot of these junior miners. The fraud that goes on is nuts with marketing and a bunch of other stuff. Almost 400 people watching the live stream and not even 100 likes yet. Okay, well, I think I'll wrap things up there. I don't see any super chats now. I want to thank everyone for listening. Thank you very much to my over 600 Patreon account contributors. It should be over 700, hopefully in the next month or so. And thank you very much to people, my monthly PayPal contributors, and people throw me a tip once in a while with through my website. You can do a one-time donation through PayPal, or people throw me a crypto tip with Bitcoin or one of the other cryptocurrencies. The address links are in the information and description section, along with the articles I referenced below the video. So I want to thank everyone. Have a great weekend. Excuse me, today's a Tuesday. It's not a great weekend yet. Shows you how hard I've been working. I forget what day it is. Probably need a vacation. There's so many stories to cover, though. It's insane. It's really insane, all the stories that are coming out. I have enough material that's been coming out now for the next, I would say, 6 months.